Welcome back to the deep dive. Today we are really zooming in, focusing just on the Q&A part of Alphabet's Q3 2025 earnings call.
Yeah, exactly. We know the headlines already, right? First $100 billion quarter, clouds booming, AI momentum, U2 strong.
Absolutely. But the prepared remarks, they give you the polish. The Q&A, that's where you get the unscripted bits, the strategy under pressure.
That's where the analysts dig in. How are you actually going to make money from this next-gen AI? And how on earth do you justify spending, almost $100 billion to build it?
That's exactly what we're digging into. We want you to understand the why behind those giant numbers. And maybe the best place to start is, well, the future of search. That seemed to be top of mind.
Definitely. Analysts like Brian Nowak really pushed on this idea of agentic e-commerce. The AI acting like an assistant, doing things for you.
Right. And the big fear there is if the AI just finds the answer or buys the thing directly, what happens to all those ad clicks that make search so profitable now?
Precisely. Nowak basically asked, does this new agent stuff make less money?
And the official line was that these agentic experiences are additive, which, sounds a little bit corporate speak. Is it just masking cannibalization?
It could sound that way, yeah. But their argument, the defense of additive, is that these AI agents help people tackle questions or tasks that were maybe too complex for traditional search.
So like planning a whole complicated vacation itinerary.
Exactly. Something that wouldn't just be a few simple clicks anyway.
Yeah.
So the idea is it's creating new commercial activity, not just shifting the old stuff around.
Okay, and how do they make sure the money follows if the agent does the booking?
While they talked about integrating partners directly, mentioning new agentic checkout features. So the AI might handle payments using, say, PayPal, working through these open protocols for different agents to kind of talk to each other.
Building a whole new transaction layer almost.
Sort of, yeah. Seamless for you, the user,
Mm-hmm.
but with clear points for monetization built in with partners.
Okay, staying with the future, but shifting gears. Waymo, the self-driving cars. The question wasn't just, is it growing, but about linking it into Gemini, the core AI.
Right. Imagine Gemini knowing your flight plans and proactively booking a Waymo for you, or rescheduling if your flight's delayed, that kind of thing.
That's the real value unlock, isn't it? Profile-based service.
Totally. And they confirmed they're actually reviewing that deep integration very soon. The timeline was interesting, too. They said Gemini, especially its multimodal abilities, plus things like YouTube, could make the in-car experience dramatically better, starting in 2026.
2026. So Waymo isn't just some side bet, it's becoming a platform for their core AI.
That seems to be the strategic direction, yes.
Okay, let's pull back from the future for a sec and talk about right now. The core search business, the moneymaker, how is it actually doing with all these AI overviews and AI mode changes rolling out?
Well, the numbers they shared were, frankly, pretty strong. Paid clicks up 10% year over year.
10% growth in clicks.
Okay, and cost per click, the CPC, that was up 7% year over year.
So more clicks? And advertisers are paying more per click. That doesn't sound like a business in trouble.
Not at all. It suggests advertisers are still finding value, even with the format changes. But the crucial point was about the AI overviews themselves. The big worry was that those synthesized answers at the top would kill clicks.
Yeah, the existential threat.
And the news here was, I think, a huge relief for investors. They reported that AI overviews, including the ads shown above, below, even within the AI answer, are monetizing at, quote, approximately the same rate as the traditional ads.
Whoa, okay, hold on. Approximately the same rate. Parity.
Parity.
Right out of the gate.
It's incredibly important. Why is just maintaining the rate such a big deal?
Because it basically neutralizes the biggest fear about the AI transition, that it would automatically mean less revenue per search. If it monetized lower, say 70 or 80%, that's billions potentially wiped out. Achieving parity means the new format is sustainable.
And they see it as just a starting point. Exactly. They called it a great baseline for further innovation.
Yeah.
Suggesting that future, richer ad formats within AI overviews could actually drive monetization higher. It's a massive win for their ad tech team.
And a specific product driving this is AI Max, right? We hear that name a lot.
Yeah, AI Max is key. It's their fastest growing AI ad product. Apparently, in Q3 alone, it unlocked billions of net new queries for advertisers.
Billions? How does it do that?
It uses AI to match ads to searches they weren't previously showing up for, basically finding relevant queries the advertisers were missing, better targeting, more efficient spend.
Is there a concrete example?
They mentioned Kayak. said Kayak saw a 12% jump in conversion value after they enabled AI Max. So real money, real results. It shows the AI isn't just a user feeder, it's a revenue engine on the back end too.
Looking forward then, what does search even look like in a year or two? Do we have AI mode, AI overviews, and the classic blue links all living side by side?
They hinted at simplification, drew a comparison to how they rolled out universal search way back when, integrating images, video, news, etc. into one results page.
Okay, so it becomes more seamless.
That's the vision. You won't have to think, am I in AI mode? The system will just figure out the best way to answer your query, whether it's links, an AI summary, or something else entirely. Simpler, more unified over the next, say, 12, 24 months.
Okay, let's pivot hard now. The cost. Building on this AI, it's eye-wateringly expensive. CapEx heading towards, what, $93 billion for 2025, plus massive depreciation hitting the P&L. How do they manage that?
Yeah, that huge number reflects the sheer scale of investment in their own infrastructure, data centers, custom chips, everything. Management really stressed that finding efficiencies isn't a one-time project. It's like an ongoing discipline.
So things like moderating hiring growth, optimizing buildings.
Exactly. Squeezing efficiency out of headcount, real estate, data center design, but also crucially, using their own AI internally.
Eating their own dog food, so to speak.
Yes.
Using AI to make themselves more productive.
Absolutely. It's kind of the ultimate validation. They mentioned that nearly half of all the code their developers write is now generated by AI.
Half. Wow, that's a serious productivity boost.
Huge. It helps offset some of those massive infrastructure bills.
Speaking of infrastructure, the custom silicon, TPUs, GPUs, they kept emphasizing their full stack approach. Why is building their own chips such a big deal, especially for cloud?
It's a fundamental differentiator. You see, Alphabet is pretty much the only one of these giant cloud providers, these hyperscalers, that's building cloud services on its own AI models running on its own custom chips.
So they're less dependent on, say, NVIDIA for everything.
That's a big part of it. Owning the stack, from chip design up to the AI models and the platforms, gives them way more control over costs. They're not just subject to market prices for essential components.
And better performance, too, presumably.
Yeah, they can optimize everything to work together perfectly. That leads to unique, differentiated products. And that control, that differentiation, is what gives them the confidence they can keep improving operating margins in the cloud business, even with all the investment.
But with nearly $100 billion in CapEx planned, how do we, or how do they, measure the return? How do you know these huge long-term bets are actually paying off? ROIC, return on invested capital.
They said they have a strict framework for that, yeah. But maybe the best proof isn't a framework, it's results.
Yeah.
They pointed out the cloud business is already generating billions from AI this quarter.
Okay, so it's not just theoretical future value. The AI investments are generating substantial revenue right now.
Exactly. Which helps justify continuing that high level of spending.
That leads us nicely into the momentum they highlighted in cloud and YouTube. Let's start with cloud. The deal velocity sounded insane.
It really did. Get this. Cloud signed more deals worth over $1 billion in the first 9 months of this year than in the entire previous 2 years combined.
Wow. More billion-dollar deals in 9 months than in the prior 24.
Yeah. It just underscores the massive enterprise hunger for AI, and it suggests their full-stack approach is really resonating with the biggest customers.
Okay, shifting to YouTube. We usually think of YouTube as ads, but they talked up the twin-engine ads and subscriptions.
Right. They wanted to make the point that subscriptions are really valuable. They said, on average, a YouTube Music or Premium subscriber actually delivers more value to creators, to music partners, and to YouTube itself than someone just watching ads.
More value than an ad-supported viewer. Interesting.
Yeah, so that subscription base is becoming a really important, high-value part of the whole YouTube ecosystem. Helps them compete, helps creators.
Finally, the frontier models, Gemini 3s coming later this year, there was a question about the pace. Is innovation slowing down because the models are already so good?
It's more like the complexity is increasing. They acknowledge that while they're moving incredibly fast, making significant improvements on models that are already state-of-the-art sometimes just takes a bit longer.
So it's not about speed for speed's sake, but ensuring the next version is noticeably better.
Precisely. The bar keeps getting higher, so you need to take the time to clear it convincingly. It's a sign of maturity, in a way.
But even with all this progress and spending, there's still a bottleneck, isn't there? A physical limit.
Yes, this was the other side of the coin. They repeated that they expect to be in a tight demand-supply environment for their infrastructure, the TPUs and GPUs through Q4 and into 2026.
meaning they still can't build this stuff fast enough to meet customer demand.
That's exactly it. Demand for their cloud AI services is still, fundamentally, outstripping their ability to deploy the custom hardware needed to run it.
Okay, so let's try to pull this all together. The Q&A really painted a picture of a company doubling down on AI growth, right? Finding new ways to make money, like AI Max and agentic search.
Which seem to be working well enough to offset the risks, especially that big fear about search monetization being diluted. They dodged that bullet, at least for now.
And they're using that success, plus the massive cloud deals, to fuel just enormous investments in their own unique infrastructure.
Yeah, maintaining pricing power, winning huge contracts, those are clear signs of success. But that supply constraint, that's the lingering question mark.
Which brings us to a final thought for you, the listener, to maybe chew on. They're signing these record-breaking billion-dollar cloud deals, and yet they admit demand is still higher than their supply of crucial hardware like TPUs. So how much faster could cloud actually be growing right now if they could instantly magic up more custom chips? Is that physical supply chain constraint the single biggest thing holding back their growth potential over the next year or two?
It's a fascinating bottleneck, isn't it? Even for a company of Alphabet's scale, building the physical future takes time.
Something to think about. Thanks for joining us for this deep dive into Alphabet's strategic Q&A. We'll catch you next time.